Okay, so here we go, guys. Today we're going to cover behavioral finance. Behavioral finance is a very, very, very cool new field in finance. It incorporates traditional finance with some of the things that have been learned in psychology. So basically, behavioral finance is a combination of psychology with finance. Traditional finance hasn't, adequately explained some of the things that we see out there in the real market. For example, mortgage bubbles, the dot-com bubble, the financial crisis. Some of these events cannot be explained by traditional finance. And when I mean traditional finance, I mean finance that is based on rational expectations. So traditional finance assumes that all investors, or at least the majority of investors, have rational expectations. What does that mean? That means that whatever they expect, if they expect the returns to be 10% next year, though that expectation of 10% is based on rational factors. And what are these rational factors? Well, it could be fundamentals like cash flows, companies' earnings, macroeconomic factors like interest rates, labor, all these different, traditional fundamental type based factors are the ones that are supposed to influence the 10% expectation of return for the following year. So traditional finance is based on rational expectations. Now, a lot of the research that has been conducted has shown that traditional factors don't necessarily explain some of the things that we see out there, like the mortgage bubble, like I mentioned earlier, and so on. Finance folks or finance researchers have begun to look outside of the traditional finance realm into other areas like psychology to see if we can explain what is going on with investor behavior, how people are investing, and so on. So that's pretty much behavioral finance. This chapter talks about behavioral finance, and then it talks about chartists or technical analysis. We're going to cover technical analysis in a different video, but in this video we'll focus on behavioral finance. Okay, so that's behavioral finance. And also, behavioral finance is one of the things that one of the areas of study that I research. So a lot of my research is actually in behavioral finance. It's a very, very cool field that pretty much began in the 70s. Gained a lot of speed in the 80s, and now has gained a lot of acceptance worldwide. A lot of the most important research that's been found has actually come from psychologists, or some psychologists that are also finance or economics researchers. So let's look at some of the concepts, some of the more important concepts. I'm not going to cover every single concept in this chapter, but I do want to cover the most important parts of this chapter. So let's take a look at a couple of them, okay? So one of the most important theories out there is what they call prospect theory. And prospect theory pretty much goes against this idea of rational expectations. In theory, people are supposed to make decisions based on realistic probabilities, the probability of observing one event or observing another event. But what prospect theory has found is that, these probabilities aren't exactly correct. So investors don't exactly know the probabilities. That's kind of prospect theory. I don't want to go into detail into what prospect theory covers, but that's pretty much it. And also, prospect theory says that investors hurt more with losses than the benefits that they see with gains. So, for example, if you make $10, you're supposed to have, let's say, a 10-unit benefit, right? Whereas if you lose $10, you might have a 10-unit loss or dissatisfaction. So this would assume that there's equal weighting to losses and gains. But what researchers have discovered is that these losses are not equal. For example, losses hurt more than the gains. I hope I'm making myself a little bit clear on that, but In other words, it hurts more to lose $10 and than the benefit you feel of gaining $10. So losses hurt more than gains. The other idea that I want to talk about is what they call frame dependence. So in theory, let me just get a little bit of water here, guys. So in theory, if something is framed differently, that's not supposed to impact your outcome or your decision. What they found has been that the way things are framed, if things are framed in a positive light or if things are framed in a negative light, then people come up with different decisions. This is what they call frame dependence. So frame dependence is very, very important. The way problems are framed is very different. And the book gives you some examples, some quantitative examples, and I want you guys to take a look at them. They're on page 259. The next concept that I want to talk about is loss aversion. So people are afraid of losses. If you buy a stock and the stock ends up going down in value, then all of a sudden you become reluctant to sell it because you don't want to materialize that loss. So you might hold on to the stock for a longer period of time just because of this loss aversion, this tendency of not wanting to recognize this loss. Maybe the best decision would have been for you to sell that stock quickly instead of holding on to it and trying avoiding those losses and waiting for the stock to recover. So this is what they call loss aversion, and people just generally don't like losing money. So they might end up making decisions that are not as optimal. The next one is what they call anchoring. Anchoring is pretty much when you anchor your beliefs or your opinions to a certain price. So for example, if you bought a stock at $10, you might anchor to that $10 value or purchase. And then you end up, selling or buying the stock based on that $10 value. So you tend to anchor your mindset, I guess, to this $10 value of the stock. Another example could be, let's say you buy the stock for $10, the stock goes up to $15, and then the stock starts to come down to $13. So when the stock is selling at $13, you're reluctant to sell it because you anchored yourself to that new price of $15, that all-time high. You're like, well, if the stock reached $15, then why should I sell it? Right? Why should I sell it when I know I can maybe go back to $15? So your first anchor was the $10 price that you paid. Your second anchor became, the all-time high of $15. And you've changed your anchor. First anchor was 10, your second anchor is 15. So now even if the stock is trading at 13, you don't want to sell it because you have the anchor of 15. And notice that at $13 you would actually make money, right? Because you bought it at 10 and you can sell it at 13, so you would make money. But your anchor tends to change across time. As this example that I mentioned, this is very important. I think people always anchor themselves to different prices or different values. So this actually affects the way we make decisions. Another one that I think is very, very cool is what they call mental accounting. So mental accounting just means that you end up creating mental accounts and you tend to classify money into these accounts. So for example, let's say you're at a casino and you're gambling. If you started with $100 out of your own money, and then all of a sudden won $20, then you have $120. Well, you grab the $100 in your mind and put it into this is my money account, and then you'll grab the other $20 and put it in your mind into another account, which is the house money account. So you'll treat this money very differently. You'll treat the $100 as, money that you don't want to take risk with, and then you'll treat the $20 house money that you earned as money that is not very important, so you can actually take more risk with it. So you end up creating these two accounts in your mind, these mental accounts. One of them, house money, that was very easy to come by, that you can take risk with, and then the other one is your money, the one that you worked for, that is very hard to come by and you don't want to take risk with. This is what they call the mental accounting, or sometimes they also call this gambling example the house money effect. Then you end up having this idea of overconfidence. Overconfidence is very important because you end up making mistakes, financial or economic mistakes based on this overconfidence. So, for example, if you if all of a sudden over the last couple of weeks you've made a lot of money in your stock account or your broker account, and so you made all this money, you end up thinking that you're a very good investor, that you've done really, really well. So you're overconfident in your abilities to make money. And once you become overconfident, you end up taking more risks and you end up making more mistakes, or potentially making more mistakes. So overconfidence can lead to poor financial decisions, or too much risk taking. So let me give you an example of overconfidence. And this is, I think, very, very interesting that they've actually studied this. But what they've asked people, they've asked them, how good are you as a driver, right? Are you above average, average, or below average? So they surveyed people, are you above average driver, average, or below average? 80% of the respondents think that they're above average. So this is pretty much impossible, right? How can 80% of the people be above average? So people are overconfident in their driving skills. And this can lead to poor decision making. So if you're overconfident with your driving skills, you might want to, not insure your car or underinsure because you think you're not going to wreck because you're overconfident in your driving. So the same thing happens with investments. I mean, if you tend to do very good in the recent past, right? You made a lot of money in the last 2 weeks or in the last half year, then you're going to be overconfident in your investing abilities, and you're going to end up, taking more risks than necessary. So overconfidence has a big, big impact on the way we make decisions or invest money. The other concept that I think is very cool is what they call the illusion of knowledge. So sometimes, you'll get information that you think is knowledge or that you think will actually help you in investing, but the information really is not going to help you in investing. So it's this illusion of knowledge. What's the next part? Another thing that I want to talk about is what they call recency bias. So if recent information has a greater impact on your decision making than older information. Okay, so if you held a stock, for the last year, let's say you had a stock for the last year, but just recently it did very well, then you might tend to think it's a better stock than what it really is, or you might tend to forget that maybe that stock did poorly in the past, just because it's done really well in the last couple of weeks or something. So we tend to give too much weight or too much importance to recent information, and we tend to ignore the older information. That's what they call the recency bias. The other one is what they call the self-attribution bias, and this one I like particularly because it gives too much weight to let me stop right here because we're going to reach this 15-minute